Enterprise Techies, welcome to our October New York Enterprise Tech Meetup Gone Global. A big welcome to any first timers in the audience. For newcomers, for some context, each month for the past 8.5 years, we have brought together suits and hoodies across Fortune 500 execs, enterprise startups, and investors for our New York Enterprise Tech Meetup. While we miss in-person networking, a benefit of being on Zoom is that we can extend our speaker reach and avoid travel logistics, which makes scheduling tough sometimes. So for everyone in the audience, please feel free to reach out anytime with requests for future speakers. We're always all ears. For anyone who doesn't know me, I'm John Lair, and with me is my Workbench co-founder, Jessica Lin. Workbench is an enterprise VC fund based here in New York City. While we invest across the country, our focus is on New York, which represents 70% of our portfolio. Our sweet spot for investment is live products early in their go-to-market journey. And this usually corresponds to a seed 2 round in the $3 to $6 million range. We're obsessed with all things go-to-market at Workbench, and you'll see this reflected in our speakers, our keynotes, and our panels.
Awesome. Thanks, John. So for today's meetup, we've got an amazing lineup with a demo from Meroxa and a keynote from esteemed SaaS investor and managing director at Redpoint Ventures, Tomasz Tunguz. I know we have many religious readers of Tom's blog and his book, Winning with Data, in the audience today. So thrilled to have Tom share the most important SaaS metrics founders need to know at every stage. Before we begin, a few reminders. Our hashtag is NYETM, so be sure to tweet away and tweet often. You can view all videos from past meetups on the Workbench YouTube page, including today's session. And we'll leave time for audience Q&A, so be sure to add your questions to the chat. And with that, we're very excited to kick off with a demo of Meroxa. A big welcome to CEO and co-founder DeVaris Brown, as he shares how Meroxa is helping to automate away the grunt work of data engineering and create real-time data infrastructure in minutes, not months.
Thank you for that very warm welcome, Jessica and John. It's a pleasure to be here. Thomas, it's a pleasure to share the stage with you. As Jessica mentioned, I'm DeVaris Brown. I'm the CEO of Meroxa, and we are building a real-time data platform as a service. And really what our goal is, as Jessica mentioned, is to make sure that any engineer or team can create real-time infrastructure in minutes, not months. We are backed by some of the best investors in the business. So Root Ventures, Amplify, led our seed round, and we also have participation from folks like Village Global, Hustle Fund, Menlo Ventures, Meritech Capital, Addition Partners, and a slew of angels that really are helping to make sure that this is a great product. And with that, I will jump into a very quick demo to show you what we can do. And yeah, and I think we'll leave some questions at the end for Q&A. Sometime at the end. So let me share my screen. All right, so what we're gonna walk through is a day in the life of a data engineer at a fictional e-commerce startup. There is no, kind of magic behind the screens. As you can see, nothing was already done. So we're gonna walk through this in real time. Say a quick prayer. Hopefully this works. All right, so the first thing that we're gonna do is just kind of walk through and show how the platform can save time. And this is an open source e-commerce store. And so the first thing that we need to do is introduce the Postgres database to the Meroxa ecosystem. And so what this happens, we basically create a change data capture connection to a regular Postgres database. All right, so we reach out and we inspect the resource to figure out what we can do. And we set logical replication equals true. If we weren't able to do logical replication, I know some people have done change data capture in the past, but what we do behind the scenes is actually inspect the resource to figure out what are the capabilities that we can do. So if change data capture is available, what we will do is use change data capture. If it's not, we'll fall back down to JDBC. And then if not, that doesn't work, then we'll fall all the way back down to polling. The important point is that the output looks exactly the same. It looks like a real-time stream. So the next thing, kind of the first use case that we want to walk through is like, an analyst wants to get customer activity into a data lake so they can actually run their queries without slowing down the production database. And so we're going to use S3 for our data lake. And all I'm doing is just passing in some credentials, giving it a name of data lake to be referenced later. For the people that are doing regulatory and compliance, just like I set metadata in the first command to be logical replication equals true, I can actually set the property for data compliance like object lock equals true for an immutable bucket. And so basically what I need to do now is I need to create the connection between Meroxa, the Postgres database, and the S3. So all I'm doing is literally hitting making a command and say, hey, connect my data store to my data lake. And that's it. Now we have changes that will be streaming through. And so as you see, there's nothing behind the screen. And so basically what you see are two things behind the hood. And I'll show you Meroxa list connections. And so we have we're obviously running change data capture, and then we have a connection from Postgres to S3. And so now we go ahead and make a purchase inside of the store. Just go ahead and do this real quick. Add some information. Check out. All right, got a coupon. Cool. So now let's go over to S3 and hit refresh a couple times. And so in a second, we should see our data lake. And so now one of the interesting things is that, if what comes in is a gzip list of structured data. So one of the things that we do is that we encode the DDL, your schema, inside of the stream. And so every time that you make an action, it is like one line, one gzip JSON that you can use to consume inside of AWS Athena or something like Presto. And so now with that same stream, this will be the last example. What if I want to actually use this and put this into my data warehouse, like a Redshift? And so one of the things that we can do is that we will introduce the Redshift resource into our Meroxa data catalog. Cool, now we have the resource. And now essentially what we're gonna do is that we are going to use this stream, that one right there, and we're gonna point it towards Redshift. And again, if you notice, like I didn't have to do anything to create the Redshift cluster, didn't have to embed any schema. It should just automatically just work. And now we have the ability to run a data lake and do some queries. And then also now we have the ability to do analytics with Redshift. And so now we're up in Redshift. And notice, like, I didn't have to make any change to the app code, didn't have to make any changes to the data lake, didn't have to upload any schemas, any of that stuff. Literally, we just set up a Kappa architecture in minutes, not months. So that is the demo. And I will take any questions if you all have anything to ask.
That was a blazing fast demo. I'm very impressed that you got that all in the 5 minutes.
You taught me 5 minutes. So,
I know you did it.
And it goes with our theme in minutes, not months. So yeah. The question I might have out there is like, if y'all are doing this now, how long did it take you and how many resources did it take you to do that? So let's see. Yes, you can limit what tables are sent to S3. You literally, so what we did was that we said, like, we want all tables. You can do all tables, a single table, or a group of tables. And all of that will be sent over to whatever S3 or Presto, or, we have other destinations that you can send it in. But the main thing is that, like, it's a real-time data stream, and you can multiplex that single stream out to multiple places. One of the things that was kind of done behind the scenes is that, yes, we do support other databases other than Postgres. We got MySQL, Mongo, Cassandra, MS SQL, Oracle, and Postgres. How does this compare to Fivetrain 6? It's like you were in my pitch presentations. That's literally the questions that I get all the time. Jessica remembers, we're real time. So we allow you to do this in real time. The thing with Fivetrain is like everything gets into the data warehouse. They don't allow you to do any transformations in real time or in flight. We do. So you can actually do real-time stream manipulation. And then that allows you to get all of your data into the data warehouse into a clean set, right? And then you don't have to worry about operationalizing your data warehouse, right? Like you literally can use that same stream of data and point that to an API endpoint or point that to, like I said, a data lake in S3, or, you know, if you want to point it to your Elasticsearch clusters, like we allow, and you want to point it to your Spark cluster, we allow you to send that same stream of data over into many destinations. So that's really the difference between us. Like most people use, you know, Fivetrain or Stitch because they're coming from the Hadoop camp. So it's really, really easy to get everything going downhill into a data warehouse and doing SQL. But just, you know, now you have to operationalize it. And so what Meroxa allows you to do from a single tool set is to give you the tools to do analytics and engineering operations at the same time. Any other questions? And again, we're real time, right? Like there's no 30-minute like wait time, and you don't have to pay us an extra $2,000 plus to get it down to 5 minutes. Like it just works. So
maybe DeVaris, could you share a little bit about your own background and your experiences, how you got here, and the pain point?
Yeah, definitely. So my co-founder and I worked at Heroku. I was a senior director of product management there, working on developer experience. So if you used Heroku in the last 2 years, thank you. You bought my mom a couch. Appreciate it. Ali was the lead engineer for Heroku Data. And we would essentially go to all these customer success on-sites and hear the same exact thing. It's great that Heroku can allow me to provision a database or a Kafka cluster with a click of a button. But what I really need is for you all to handle the orchestration in between those data components. And so we really tried to build something internal to Heroku. Unfortunately, Heroku had a strategic shift. And so this left the opportunity for us to go out and build Meroxa. And that's where we are today. And we're helping, you know, we're going to be launching the self-service platform. So anybody can, in December of 2020, so anybody can sign up with an email and a credit card. But we also have been working with large customers like Slack and 5 Stars and some of the other folks out here to basically the real to help them do you know, their data stuff. So again, not only is it going to be accessible, but it's also scalable and secure. It's kind of what you want from a data platform. Our whole thing is we want to make sure that people are empowered to do their jobs without having to bother a data engineer, right? Like if there's any data engineers here, you know that you know you're going to get inundated with a bunch of requests to build these pipelines. Now with Meroxa, you have the ability to quickly get something up, going and test it, and eventually when we launch our dashboard and self-service platform, you'll be able to empower your analysts and data scientists to do all this stuff on their own, and they don't have to bother you. We are here for you.
Awesome. Well, thank you so much, DeVaris, for this. For any additional questions, DeVaris, do you mind actually putting your info in chat for anyone who'd like to follow up and talk a little bit more about Meroxa? Right
on. All right. Thank you very much for the opportunity, and I hope you all have a great rest of the day.
Thank you. Awesome. So with that, I think, again, Tom needs no intro on all things SaaS Metrics. I know you're about to drop some awesome knowledge on us. So over to you, Tom.
Awesome. Thank you so much, Jessica and John, for having me. I'm thrilled to be here and super impressed by DeVaris's demo at Meroxa. I mean, if anybody knows anything about developer experience, it's DeVaris. And I've been a longtime Heroku user and benefited from a lot of the important product management work that he's done, and super excited to see that Meroxa is getting off to a great start. So I'm here. Let me share my screen. Thrilled to be talking to you today about the essential guide to SaaS Metrics. And let me just kick things off by telling you all a little bit about Redpoint. So Redpoint, we've been around for about 20 years. We invest anywhere from about $1 million to $40 million across rounds. We invest from an early fund and a growth fund. We're primarily enterprise investors, so 75% of Our commitments are in B2B companies, and that's split evenly between enterprise and software companies, and 25% are in consumer. We're based in San Francisco with offices in Menlo Park, but we invest all over. And we've been fortunate enough to have partnered with some really terrific companies in the last 5 years, 27 unicorns that have generated 80 billion in IPOs and M&A. And we work with many of the leaders in as-a-service companies like Snowflake, Stripe, Twilio, Hashi, Looker, and Zendesk, amongst others. And today I'm going to be walking you through the essential guide to SaaS Metrics. And I'm going to take a little bit of a different tack than you might normally see. Because when I was preparing this talk, I was meeting with lots of executives from different businesses. A handful of our companies are doing recruiting. And I realized that my thinking about a SaaS company is actually pretty outmoded. And I say that because in 2016, I'd written a post that was called, Your SaaS Company is a Series of Funnels. And the whole idea was that marketing would start a funnel that would go to an end. So you'd find people who are interested in a product that would generate an MQL or an SQL. Then the sales funnel would start, and that would kick off a sales process that would drive to a conversion that would kick off another funnel to go to customer success. And what I realized in talking to our portfolio companies and talking to modern leaders in these disciplines, and then also doing some analysis for our portfolio companies in terms of what was going on within their customer base, is the funnel analogy actually doesn't work. It's got a pretty fundamental flaw. And the smartest people they weren't talking about funnels, they were talking about cycles. And these cycles typically have 6 steps. The first is awareness. And this means getting somebody interested in, a product, then engaging them in a conversation, which, a combination of those two is often content marketing. Maybe you talk to an SDR, salesperson. Then you're sold, you're onboarded, you hit a customer success person, and then you might refer or expand. And this idea is fundamentally different from a funnel because the idea of a funnel is you take somebody from the beginning to the end of the funnel and then you drop them to somebody else. And what's really happening in business isn't that. What we're starting to happen and see businesses is what they want is a flywheel effect to happen. And you can see this in product-led growth, where what you really want is you want to make that person aware, you want to engage them, you want to sell them, you want to keep them involved, and either expand the account through net dollar retention or help them or by cross-selling a product, or you want them to refer somebody else or grow within the org. And so it's really much more of a cycle than it is a funnel. And the idea is that you're basically turning a funnel and making it a circle and building a feedback mechanism, which accelerates this and builds momentum. And it was Kenny Van Zandt who was the architect of the SolarWinds go-to-market, which was a publicly traded business that built commodity networking tools. And he architected it there and then really deployed it at Asana, which obviously had a really successful IPO this year. And now you're kind of seeing this idea of these like flywheel businesses or product-led growth businesses really starting to succeed. And even enterprise companies with ACVs 150K plus are really starting to adopt these ideas, particularly as software companies that used to deploy on-prem are now starting to deploy as a service or in cloud prem. This isn't a new idea. So I wrote a blog post about this on Monday, and a reader wrote in and said, hey, turns out HubSpot has you beaten. And so the way that they think about it is this way. What they do, if you look at their 3 concentric circles, there's the strangers who then become prospects, who become customers, who become promoters. And what you're doing within the internal processes are attracting, engaging, delighting. And then that leads to the center goal of growth. So this is another sort of mental model for thinking about this new frame of thinking about it. But I definitely wanted to put it there because they beat me to the punch, and it might be more visually pleasing to some people in the audience. And if you take a step back and you think about a SaaS company, there are actually 3 major cycles within a business. There's the customer cycle, which is the one that we just talked about, that's demonstrated within the HubSpot cycle, which is really all about taking a customer and taking somebody who's interested in the product and making them a customer and then making them successful. The second one, which is equally important, is the talent cycle. And we don't really talk about this a lot, which is how do you attract, retain, and grow people within the org, which is probably the most important asset of a business. And then there's the capital cycle, which is how do I finance my business? And there are many different ways of financing a business. You can finance it through venture capital, debt, bootstrapping, crowdfunding. In this presentation, I'm really going to be focused on venture capital. So like a funnel, what you want to do with the cycle is actually assign one key metric to each step in the funnel. And what you want to do with that metric is you want to make it a composite metric. You want it to be the highest level metric possible. And the reason you want it to be a composite metric is when it exceeds a bounds, like when that metric is either higher than you expect or lower than expect, what you want to do is be able to send a team or a person and go and double click and understand, hey, what's not working? And so for a standard SaaS company, these would be some, within the consideration set of what metrics you might use in order to understand what's going on within the business. So at the awareness stage, it might be inbound leads. How many people are coming to the website? How many people are coming in through social media, through referrals? And where you really want that to be is super linear to ARR, meaning if you're trying to 3 to 5x your ARR growth, you really would like the lead generation rate to be faster than that to make sure that you can continue to grow at the rate that you're talking about. And that's the reason that you want it to be super linear, growing faster than the growth rate of ARR is typically, you want to sort of hedge that the conversion rates actually decline at scale, which tends to happen to some businesses. The next step is engagement. How do you engage somebody and get them to buy the product? And if you look at sales qualified lead close rate, so the second marketing passes an SQL to sales, it's put into Salesforce. It's called stage 2 within Salesforce's nomenclature. You really want to look at what is my close rate. And if you look across most SaaS companies, you typically see a 15 to 40% rate. And the distribution here isn't normal. You're really going to see a lot more people sort of in the 15 to 20% close rates, but there are some companies, particularly the ones that do a lot of qualification up front through product or other means, who are going to be kind of approaching that 30 to 40% close rate where, just fantastic product market fit. And so, 50 to 75th percentile is probably going to be in the 15 to 20% range, maybe 25%. For an early stage company or ARR growth, you're typically looking at something like 3 to 5x. So, one going to 3, one going to 5, 2 going to 7, something like that. In terms of onboarding, the metric that I would recommend is first year logo churn. And what you really want to be is less than 10%. And this is true across like SMB ACVs, mid-market ACVs, and enterprise ACVs. We did a go-to-market survey that I'll show you or I'll link to in the next couple of slides that really looks at the performance of different companies by first logo churn. And if you can achieve that less than 10%, you're really in a good place. The key metric for success is net dollar retention. Again, in that survey, we looked at NDR across a bunch of 500 different companies, and we found that top quartile is 120% plus, and top decile is 140% plus. And you can see in some of the new publicly traded companies, they're starting to release data, and this is an absolutely critical metric for them just as much as it is for an early stage company. The last part, as I was preparing for this presentation, I was really thinking through, hey, what's a good metric for a referral rate? And unfortunately, or maybe it presents an opportunity. We haven't measured this in any company. The only story that I have is Bill Nasitis, who's the CMO at Zendesk and CMO at Slack. He was very deliberate about, in the early days of Zendesk, creating active referral programs from customers. And he would actually identify, I think it was the top 5% of customers who were real champions for the product and sort of put them on like gentle quotas for doing referrals. But the point here is this is not very well known, it's not very well understood, and it's definitely something that I'm going to be looking to understand in the next year, maybe part of next year's survey, is really how do the most successful companies drive referrals, and what performance metrics are you looking to generate? And these referrals don't just lend themselves to, or aren't just limited to customer referrals. They can also be things like channel partners and system integrators or technology partnerships where those people are actually referring business. And so maybe, understanding the totality of that referral and the ecosystem around the business is super important. Let's see. I'm just looking at the questions. How do you think about logo churn versus net dollar. Oh, please ask questions as we go. It's way more fun for me if we do it this way. Is it better to look at revenue churn rather than logo churn? Both are important. Typically what you find is that early stage companies, like if you're in the Series A, what you're really after is velocity maximization. You want to capture as many different customers as quickly as possible rather than maximizing the value of an individual customer. And so you're trying to get lots of logos. And when those renewal periods come up, let's say at the 1 year mark, you don't want to see a lot of churn. If you see a lot of churn, say more than 10% in the mid-market and above, or more than 15% at the SMB, it means you got a leaky bucket and it's probably time to take a step back and take a look at that. Revenue churn is important, but it's actually probably the more important metric of the two, particularly as the company scales. But logo churn in the beginning is really important to make sure you have really good product market fit. Okay, Austin asks, how do you think about new logo churn versus NDR, especially for companies like Stripe or Shopify, where they grow their clients, but also experience churn when their clients fail? So you should separate the world, Austin, into two different. There's the contractual, like as a service companies where I'm going to sign up for Salesforce for a year. I'm going to pay $175 per month per seat. And then there are the transactional as a service companies. So like Stripe or Twilio, Shopify is also transactional, where the revenue of the company is really tied to, it's not predictable because no one's contractually committing to spend a certain amount of money on it. And so measuring NDR for, say like a Twilio or another company that's like a utility-based pricing is harder. And what the more sophisticated CFOs do, I was curious about this question, so I asked a few of those CFOs, is they look at a very large segment of the customer base and basically predict or estimate how they're going to perform and treat them as if they were contractually obligated, and then take a conservative view of their net dollar retention because it's not truly recurring revenue. Okay, let's see. A ton of metrics. What about Net Promoter Score? David asks, you can measure referrals, speaking at conferences. Yeah, so David, those are all sort of great. I mean, there are lots of different ideas for metrics and every company is going to be a bit different. This is really just a framework. Okay, John Cooley asks, what importance do you put on sales productivity metrics and looking at the customer cycle? Great question, next slide. How early should be tracking LTV to CAC? Asks an anonymous attendee. I think LTV to CAC you should only track after the business is 10 years old. The real metric, and the reason is you won't have any sense of what the real LTV is until a customer is actually churned or a large fraction of that customer base is churned. And so what you really ought to be tracking is payback period. Because what you're trying to answer with either of these two metrics is how much more money should I be spending in marketing? It's sort of an efficiency score. You know, historically the LTV to CAC, you'd say if it's better than 3, then okay, dump a bunch of cash. And that may be true, but if you're a year old, you have no sense of what the LTV is, and so that might be a kind of bad indicator or just a lossy indicator. But if you look at payback period and particularly gross margin burden payback period, it's going to tell you immediately, okay, I can recoup my sales and marketing spend in 9 months and 12 months and 18 months. And what we've seen is that, top quartile is kind of around 14-month payback period. The bigger enterprise deals are kind of in the 18-month period. And so that's just a much sort of a leading indicator rather than a lagging indicator. Okay, if there's a leaky bucket, what are good strategies to diagnose and turn around metrics for SaaS products? Great question. Okay, so once you've got the metrics, the high-level metrics that you want to establish for your business, the next thing is to figure out what those value ranges are. And that's where benchmarking is super important. So I'll distribute this presentation later, but there's a go-to-market benchmarking link that links to the Redpoint go-to-market survey, which is here, which literally has more than 50 slides of different benchmarks on lots of different things, like what the headcount should look like as a business as it scales, what the inside sales quota ought to look like, span of control, which is how many AEs per manager exist within different teams inside versus outside. And then things like if SDRs hit quota, what is the impact for AEs? And so link to that. But the idea is once you've actually created these metrics, then you should go and benchmark and figure out what you want to be targeting. And then somebody asked a question here, anonymous attendee, if there's a leaky bucket, like let's say here we've got a case of ARR growth is not growing as fast as possible. So remember we talked about the idea that ARR growth is a composite metric. It's actually the highest level metric. And there are a bunch of things that underpin that ARR growth. The first is how many new accounts am I closing? The second is at what price am I closing those new accounts? The third is how many existing accounts exist? And then the fourth is how many of those existing accounts have expanded? If I, add and multiply those four things in the right way, I'm going to get to my ARR growth number. And so if one of the composite metrics is wrong, what you really want to do is be able to dive down and figure out, okay, it turns out that the new business is actually suffering. Is it because of my accounts? The number of new accounts are coming in are too low, or is it because my ACV is too low? And if it's my new accounts count that's too low, is it because I don't have enough AEs, the quota is not high enough, the quota attainment's too low? And if the quota attainment is too low, it's probably because of my pipeline to quota ratio. I'm not generating enough leads to be able to feed the field, right? And so what you want to do is at the board level, at the management team level, you start with a dashboard that looks like this. And then whenever there's an anomaly, you go through an exercise like this. And you can do this either at the beginning where you actually map out what one of my managers used to call the fundamental equation of a business, or you do it on an ad hoc basis. But the idea is to basically distill a particular problem down after that sort of high level alert. One thing I do want to mention before continuing is the other reason I really like the cycle compared to the funnel is that, remember when I was talking before about how marketing has a funnel and sales has a funnel and customer success has a funnel? Well, each of these teams decided to instrument their funnels, and so they created the marketing ops team, the sales ops team, and the customer success operations team. And what we've seen in the most modern companies is those teams actually sort of centralize and become the single revenue operations team. And what they're trying to do is actually optimize across all those funnels. And you'd be surprised, but it actually, in order to optimize customer success, marketing may have to do things that actually change the dynamics around their funnel that may make their metrics look a little bit worse. And so you don't want to get into that dynamic. The benefit of a funnel is that in this case, the sales team, the marketing team, and the customer success team all have to work together to look at it from an end-to-end optimization, as an end-to-end optimization problem, as opposed to piecemeal optimization problem. And so you actually get better cross-functional collaboration as a result. Okay, let's hit some questions. Should you start tracking AR growth rate once you get to a certain number in revenue, at $1 million or before that? So typically what we see, I think it's got to be Julian, I'd guess, given your last name. Typically what we'd see is in the early days, like sub $1 million in ARR, most people are tracking monthly MRR or ARR growth rate. And a lot of companies sort of target that 10 to 20% per month. It's probably closer to 10%. And then after that, they start looking at like ARR on an annual basis. But it's really at the point where you've got like one founder who's the majority of the time is focused on selling. That's what you see most often. For the onboarding metric of first year logo churn, is this the churn that happens specifically within the first year? Yes, it is within the first year. Okay, let's see. David Medeo asks, doesn't customer marketing and prospect marketing have very different goals and outcomes? Yes. So there are two different kinds of marketing that you're talking about, David. The first is somebody doesn't know anything about Redpoint. How do I get them to understand and love and be excited about Redpoint? And the second is we've already invested in a founder and we want them to love Redpoint and to recommend us. And both of those skills in marketing exist on what's called the customer lifecycle journey, which is probably one of the more important things that we recommend for startups to do and is a key part of product marketing, which is how do I get a customer from not knowing anything about us to recommending us? What are all those different stages in marketing? What are all the different campaigns that we're running? And what are all the delivery mechanisms that we're driving them? So do we deliver by blog? Do we deliver by webinar? Do we deliver in product messaging? There are lots of different vehicles. But you're right, like the messages that you're going to give to somebody who's never heard about your business are going to differ meaningfully from the ones who are, initial users who you want to become advanced users. But it's definitely marketing's role to support all of them.
Tom, we also have some questions popping up in chat as well. So just wanted to call that out for you.
Oh, okay, thanks. Let's see, I missed chat. Okay, cool. Let's see. Sorry. Okay. Regina asked, is it better to look at revenue churn rather than logo churn? I think we touched that in that one. Akshay asked, how is onboarding defined? If book to billing, then why first year logo churn? I don't understand that question. Akshay, can you clarify and then I'll come back to it? Can you share your calculation for net dollar retention? Okay, Mike, so the standard, like the way that we do NDR is gross profit in Q2 minus gross profit in Q1 divided by sales and marketing period Q1. And the idea is you do the difference between the gross profit. So what's the marginal gross profit that I have generated in Q2 given the marketing and sales and marketing spend in Q1? That's the one that we use. And the reason we use gross profit is because Twilio operates with 50% gross margins and GitLab operates with 90% plus gross margins. And so you can't treat those net dollar retention figures the same for the purposes of marketing spend. Because you know, a dollar revenue is not the same for either of those companies. Mayor asks, what is an allowable win back period? So you've lost a customer, they churn. What is an allowable win back period? How would you handle a logo that never onboarded, who you gave a refund or never charged? Yeah, interesting question. Most of the companies I work with consider those a churn and then welcome them back. And there's lots of different ways to do it. And it's actually a really important topic in a time of COVID. So imagine in whatever, January, you book $1 million, $100,000 year customer, they go through some hardship, they contract, they want effectively a 2-quarter furlough, and then they kind of bring you back. The way that most of our companies have done, and you can do it in lots of different ways, is to say, hey, they churn by 50% and then they expand later. And you actually adjust your overall business ARR for that. That's one approach. It's definitely the more conservative financial approach, but it's really an accounting question because it's more of an accounting question. The only time it's actually sort of a more tactical question is on sales commission. You know, if somebody kind of churns halfway through the period because of COVID, do you actually reduce the overall commission paid to a salesperson? And so, you know, that's sort of a conversation you should have with your VP sales and take a look at your burn and all that kind of stuff. But that's really sort of the tactical question that you should be focused on as opposed to sort of the accounting question. All right, let's see. Okay, Regina asks, okay, can you explain positioning under marketing more? Okay, so in marketing, there are 4 Ps, and I will put a blog post in the chat later on. There's packaging, positioning, pricing, and I forget the last one. Let's see if we can find it. And they're basically the 4 cornerstones of marketing. And when you think about your marketing mix, one is, you know, pricing is obvious, but the product is the last one, of course. So there's what you sell, there's how much you charge for it, there's where you sell it, and then the last is how you sell it. So let's take DeVaris' company. One positioning would be to position to the individual data engineer and say, this is going to save you a lot of time. That's one positioning. And that's a positioning that's focused really on a go-to-market motion that's bottoms up. Another positioning is Mr. VP or Miss VP of engineering. This is going to, thanks, there you go. Deb, awesome. Product price promotion. The other positioning would be, okay, Miss VP of engineering at Goldman Sachs. We want to, this is the most modern platform for building data infrastructure. And so the features and the assets of the product that you're going to highlight when selling to a VP are going to be very different than what you're going to highlight selling to an individual. Another difference in positioning might be a premium product versus a commodity product. Twilio is not pricing itself as a premium, as a commodity product, but like, or actually a better example might be like Workday. You know Workday is going to be super expensive, or actually, sorry, Adaptive Insights versus Anaplan. Both companies compete in exactly the same market. Anaplan is focused on the enterprise accounts, 250K and above. And Adaptive Insights is really focused on that like 40K initial land and then expand. Two different positionings. Another great area, another great sort of microcosm to look at would be the difference in positioning between App Dynamics, which is exclusively focused on the enterprise, New Relic, which went public with a $3,000 ACV, and then Datadog, which straddles the entire ecosystem. You can kind of look at those to compare and contrast. Andy asks, how do you encourage focus on key success metrics like leads and sales meetings rather than activity metrics? You just set the goals for the team leads. That's what the OKRs become. Maybe there's more to that question, but I don't know. Within your portfolio, what company with the best SaaS metrics at launch when you invested and the one with the lowest that still managed to make it in the portfolio and become successful? So we invested in a company that we invested 2 years before they released a product. When in their first year of sales, they had negative gross margins, which means for every dollar of revenue they sold, they were losing money. And they were burning at one point $5 million a month. And now they've become a very successful company. We've invested in companies where, the metrics have just been like Looker was just, 27 consistent quarters of perfect sales attainment. And then there are companies that, do really well, kind of plummet, and then come back up. There are obviously a lot of failure cases too, but you see all kinds of stuff. So it's kind of all over the map. In gross profit for net dollar retention, what if gross margin is expanding, or if you've not clearly tracked professional services of implementation to include from recurring gross margin? Okay, so just to back up everybody, if you look at a P&L statement, your first line is revenue. The second line is the cost of goods sold, which is for a SaaS company, is typically professional services, customer success, and cloud hosting. And if you subtract all those costs, then you get your gross profit. And if you don't track that, typically PS for SaaS companies, professional services, is less than 15% of revenue. So you could correct it. I would just leave it in there and basically take the maximum fee, like all the cost of professional services, throw that in COGS. Because again, the reason that you're looking at payback period or net dollar retention is really to understand where to invest. And so if you're on the more conservative side, then you're always going to make the right decision. How do you read these metrics when analyzing a company? If it is within the range, is it okay? The greater, the better? Yeah, typically, the faster you're growing, the shorter your payback period, the better the profitability of the company, the faster the sales cycles, like all those things are better. How should early stage SaaS companies think through licensing versus maintenance subscription? How do those models change as a company grows? So 20 years ago, most software companies did a license model. And what that means is, let's say you booked a $10 million contract. You would get all of that $10 million in the first year, and then you would charge a 10 or 15% maintenance model over the life of the contract. And that was good for cash because you got all the cash up front, but sort of bad for the business because the next year you were literally starting your bookings at zero, as opposed to renewing a lot of your business. And so all of the companies that we work with now are on subscription as opposed to licensing. Yeah, I'll leave that there. Cool. So if people are curious about the metrics that we take a look at across all of these different cycles, there's a link to the template here. There's a public Google Sheet that you can download both in Google Sheets form or also Excel. And this is one of the templates that we use with our portfolio companies in order to kind of have a consistent dashboard. And what ends up happening is a lot of companies actually take this and customize it to their needs, but it kind of covers the basics. So it's a good starting point. Okay, keep going with questions. How should early stage SaaS companies think through, actually we've already done this. Alicia asks, Harvard Business School 2020 article states in 2010, only 3% of venture capital in the US went to companies with a female CEO, yet the number of female-owned businesses has risen both in the US and around the world. What do you think can be done to change this? Well, the first is hiring diverse GPs, general partners within Redpoint. And we're very proud to say that I think we've got one of the most diverse firms in the Valley. We've got 4 or 5 women on our early stage team. And we're going to be continuing to invest in that. I think what ends up happening when you hire GPs with different networks is you tend to recruit and sort of source investment opportunities from different networks. And so that's the way that we're going to do about it, or that's what we're going to do about it. But it's got to start with us. And so that's what we're doing, at least today. Casey Knapp asks, where do you see the best new sales tactics online? I don't think they're online. I think if you want to find some interesting sales tactics, then I would go through the sales processes of some of the fastest growing companies. So put your, whatever, go through the Asana sales process and try to understand what they do and see if you can draw patterns. Steve Porter asks, can you please put the link in the chat? Yep. I'll do that later. When setting goals in OKRs, how do you make sure your KPIs don't measure vanity metrics? Yeah, I mean, you have to think about okay, so a vanity metric is like, well, okay, so let me see. There are 3 different kinds of metrics. So there's lagging indicators, like revenue is a lagging indicator. There's a leading indicator, which is qualified pipeline. If I look at qualified pipeline, I can predict revenue in the future. And then there's vanity metrics, which is logos, let's just say, or like Fortune 500 logos where you don't really care about the value of those individual accounts. I think basically what it comes down to is people holding each other accountable and figuring out like, okay, is this a vanity metric? Is this a leading indicator or lagging indicator? If you could put all of your chips in one bucket, it'd definitely be in the leading indicator because then you can predict the business in the future. Okay, how are we doing on time? Okay, so I prepared 3 case studies here. They're anonymous. One case study, it was a growth stage company who saw high variance in bookings. And what this means is in one quarter, it would be incredibly fruitful, and in the next quarter, they'd miss meaningfully. And this happened for 6 quarters in a row. And so what they ended up doing, this actually surfaced in one of the reports that they presented to the board. We ended up going and trying to understand what was going on in the pipeline. And we found we had this like bimodal distribution of leads, where there were lots of small deals. I'm talking like sub 10K ACV, and there were many bigger deals, which were 150K plus, and there was no one in the mid-market. And so the company was sort of stressed. It was stressed because of its marketing. Like, do we market to SMBs? Do we market to really big companies? It's stressed in its sales because the account executives had lots of volume in the small deals, but really weren't going to make that quota that way. Whereas like the bigger deals, they were, harder and sort of higher variance. And then the mid-market team had nothing to farm. And so it raised this strategic question of which go-to-market to pursue. Do you pursue SMB? Do you pursue enterprise, or both? And so what we did is, we did an analysis very much like this, where we went through understanding exactly what's going on with the customer segments. And what we ended up doing is we started to ignore the SMBs because of the costs associated with them, particularly on the support side, weren't great. And we took that enterprise division, and what we did is we moved our mid-market bucket up and split them so that the enterprise AEs were now, and the mid-market AEs were focused on accounts that were 100K plus, but just basically resegmented. And as a result of that, actually the company was able to get back on track, both increase NDR and achieve greater sustainability in bookings. Okay, let's see. In cultures where 60 to 90-day credit period for subscription payments is the norm, how do you look at accounts receivable? From an investment percentage, what a point is AR percent revenue a flag? Okay, so a customer signs a contract, but they don't pay. You typically give them a grace period of 30 to 60 days. And 30 to 60 days, quite frankly, most of the time in the early stage, we don't really look at accounts receivable. The only time we really look at it is if like it's a really massive number. So it's in growth stage, you definitely look at it, and you probably, we look at it more like days sales outstanding, which is the weighted average of how many days customers take to pay. And if you see anything above like 120, I think it kind of gives you a little bit of consternation, but it's typically tied to, most of the time it's typically tied to 1 or 2 really large contracts. Cool, case study number 2. Okay, a 10-person startup growing super fast with great lead velocity and close rates. They were targeting one initial ICP. COVID happened, and then the sales started to slow meaningfully. And the way that we saw it is that the sales cycles, we were tracking sales cycles, actually lengthened meaningfully. They doubled. And we saw this in the conversion funnel, and it was from the SQL to meeting stage that there was a big issue. And so what we decided to do then, or what the company decided to do then, was to go and test a new ICP. They're 5-minute warning, thanks. They had this philosophy, lead bullets before silver bullets. Let's try lots and lots of different things. They went after a new ICP. They doubled down on their new ICP, and that really drove a meaningful increase in bookings and referrals. And we were able to do it again because we went into one of these analysis where we were looking at primarily here, the drop off between engagement and selling. We saw a pretty meaningful drop there. Cool. I only have 4 more minutes. So, talent cycle metrics, this is just as important as the revenue cycle metrics. Inbound candidates, candidate close rate, percent hired to goal, attrition, unregretted attrition, and referral rate. What does this mean? One of the metrics that you'll look at in the template that we have is how many people are actually coming to apply to the company that you work with. The next metric is, what is your candidate close rate? Of the outstanding offers, what fraction of them actually say yes? The third is, if you've got a hiring goal, how close are you? You really want to be above 90%. For attrition, like first year attrition, most startups are in the 10 to 15% range. Anything higher than that, it's really worth digging into, and that's the focus of the third case study. Unregretted attrition, so these are people being poached. Sorry, it should be regrettable attrition. It's the other way around. These are people being poached or like real stars. If that's above 5%, you've really got an issue. And this really is where like a head of HR comes in. If you've ever seen like a GE 9-box model, what you really want to do with your employee base at an early stage as possible is segment them on 2 axes, which is performance and potential. And typically you're going to find 15% of the employee base being high potential and high performance. And those people you really want to compensate at a disproportionate level. And if you look at some of the bigger companies, like when I was at Google, like you look at the super high performing executives, their compensation structure was actually exponential. It wasn't linear, it was exponential. So they were getting, 5 or 10x the compensation, particularly in stock and options of somebody normal. And that's just because you really wanted to retain those people for all the reasons you can expect. And again, here, referral rate is something that's completely unknown, but we definitely ought to study. Case study number 3, so growth stage company observing 20% employee churn. We'd never tracked the metric until a head of people comes in. Boom, first major headline is, hey, we're hemorrhaging people. We dove into the metrics. What we found is there's actually a meaningful difference in retention by managers. And what I learned through this process is the single greatest reason somebody leaves their company is the relationship with their manager. And so what we did is we went through, we moved some managers out, implemented management training for junior managers, focused the recruiting efforts on more experienced managers, and then also through the compensation committee, recalibrated salary bands to make sure we were at market or a bit above. And that translated into a bunch of different things. A much better employer brand, which we discovered, on Glassdoor, higher talent close rates, higher traffic, and it sort of led to this nice feedback loop. This is actually a much longer project, took about a year to complete. And then there's capital cycle metrics, which I'm going to skip over in the interest of time. The ultimate goal of all this stuff is really to get to predictability. I think the one CEO I work with, his whole mantra is about, I want to get my entire team to predictability. I want a VP marketing, VP product, VP eng to be able to tell me what it is that they're going to do at the beginning of the quarter and hit it consistently over and over and over and over again. And the reason that's so important is when your company becomes a public company, the thing that investors want the most or seek the most is predictability in addition to growth. That's the last slide. Let me hit the last 3 questions in 2 minutes. We've already seen SaaS transform business communication, sales, payroll. Are there any unsolved problems in SaaS that we will witness in the next few years? I mean, it's enormous. So there's about $1.5 trillion in IT spend globally. Our estimate is that only 20% of that has actually moved to the cloud. And so, if you assume a 60% terminal penetration, you're basically going to see another tripling, which means you're going to see another 20 sales forces. And where's that innovation going to come from? A lot of it is still happening in sort of the horizontal SaaS, like, all the old productivity platforms are going to be reinvented over and over again. Another big category that most people don't really talk about is vertical SaaS, whether it's like solar panel installation or like Viva or in pharmaceuticals or construction. Like those are much bigger companies than anybody expected. And wherever you see an Excel spreadsheet, that's an opportunity for a SaaS product.
All right, Tom, I think we're just about
Okay.
at time now,
I'm trying
but
to
I
whip
know
through
you
it, yeah.
covered so much in so little time, so thank you. And for everyone on today, we will be sharing these slides, so make sure to check your inboxes for them and sign up for our Enterprise Weekly newsletter. We also have a ton of stuff in there about our next NYETM. But thank you again, Tom, so much for so much information. And I think the 40 minutes we cut it down to. And thanks everyone for joining us.
Thank you.
Thanks, Tom. Appreciate it.
That was fun. Thanks.